Question 1. From the perspective of a commercial insured, Nora Patel owns a mid-sized retail store in Salt Lake City. Severe windstorm damages her roof and merchandise. Her insurer issues replacement cost policy, but Nora opted not to maintain specific coinsurance percentage. At claim time, the insurer applies coinsurance penalty. Nora argues she didn't know coinsurance applied under replacement cost form. What best explains whether the coinsurance penalty valid and why? A. The insurer must pay full replacement cost without penalty. B. The coinsurance penalty is valid because property underwriters require compliance even under replacement cost. C. The insurer can't impose coinsurance if replacement cost is chosen. D. Coinsurance only applies to actual cash value policies in Utah. Answer. B. Explanation. Replacement cost doesn't waive coinsurance. Coinsurance still applies unless specifically waived. Under Utah commercial property causes of loss and coinsurance rules, the insured must maintain at least the stated percentage, often 80% or 90% of the full value. If not, insurer applies penalty prorating recovered amount. Nora's lack of awareness doesn't relieve contractual terms. Option is wrong because coinsurance still applies. Option C misstates contract form. Option D is incorrect. Coinsurance applies regardless of a CFA or RC unless waived by endorsement. Question 2. Considering the evidence Marcus Lee runs a limousine service using employee-owned vehicles, one driver gets into an accident while on business. Marcus wonders whether his hired and non-owned auto liability endorsement will cover the damages if the owner-driver's own insurance is insufficient. Which is most accurate under Utah commercial auto practice? A. Hired and non-owned liability automatically covers all employee-owned autos. B. Utah requires separate endorsement. Without it, no coverage. C. Coverage applies only if the vehicle is rented by the company, not employee-owned. D. The endorsement covers employee-owned autos while used for business for which insured is legally liable. Answer D. Explanation. Hired and non-owned auto liability covers vehicles the insured doesn't own but uses for business, including employee-owned. Utah law and ISO commercial auto forms permit this broader coverage if endorsed. Option is overstated. Requires endorsement. Option B misunderstands insurers' practices. Option C restricts to rentals, which is narrower. Employees' owned vehicles used for business are included under proper endorsement. This protects business liability exposure. Question 3. By evaluating, Dina Ramirez is reviewing her firm's commercial general liability CGL policy. Customer sued for emotional distress, alleging false imprisonment by store security. The policy's coverage B for personal and advertising injury and coverage for bodily injury or property damage are both potential triggers. Which coverage applies? A. Coverage A, because emotional distress is bodily injury. B. Coverage C, because medical payments would apply. C. Coverage B, because false imprisonment is personal injury offense under advertising injury provisions. D. Neither covers emotional distress claims. Answer C. Explanation. Under a CGL, coverage B includes offenses such as false imprisonment and malicious prosecution as personal and advertising injury, not bodily injury. Emotional distress arising from those qualifies under coverage B. Coverage is for bodily injury or property damage, not psychological harm alone. Coverage C is only for limited medical expenses. Utah-specific form follows ISO approach. Option D is wrong. Question 4. In a modern context of risk management, Valerie Chen's Utah small business is exploring umbrella liability insurance. She already has CGL and commercial auto policies. She asks whether the umbrella policy will extend liability limits and fill gaps from exclusions in underlying policies. Which statement best captures the relationship? A. Umbrella will fill any exclusions in underlying policies regardless of cause. B. Umbrella only provides additional limits, not broader coverage beyond underlying exclusions. C. Umbrella replaces the underlying insurance completely. D. Umbrella provides coverage only if the insured purchases extra coverage extensions. Answer B. Explanation. Umbrella insurance provides additional limits above the underlying CGL, auto, or other policies, but only responds to covered exposures that are also covered in underlying policies unless specific drop-down features are purchased. It normally doesn't fill coverage gaps from exclusions. Those remain unless endorsements provide Follow form, excess or difference in conditions. Option is incorrect. Option C misrepresents. Option D is partially true but broad. Question 5. In light of recent developments, Samuel Ford has trouble understanding subrogation. His commercial property insurer paid for fire damage caused by a negligent contractor. The insurer sues the contractor to recoup the loss. Samuel asks, is his own coverage affected and can insurer still act? Which answer is correct? A. The insurer waives subrogation. Cannot sue contractor after paying. B. Insurer can exercise subrogation. Samuel's coverage and limits unaffected. C. If Samuel assigns subrogation rights, insurer is barred from suing contractor. D. Subrogation only applies to bodily injury claims, not property loss. Answer B. Explanation. Under subrogation doctrine, insurer steps into insured shoes to recover from negligent third parties after indemnifying the insured. UTOR statute allows this unless waiver of subrogation endorsement is in place or contract forbids it. Samuel's coverage isn't impacted by subrogation suits. Option is wrong unless waiver was agreed. Option C misstates. Assignment isn't required. Insurer already has rights. Option D misinterprets scope. Question 6. While examining a scenario, Gabriela Torres seeks to comply with UTOR workers' compensation rules. Her company has elective workers' comp status and recent injured employee instead sues for negligent hiring outside workers' comp. She wonders whether exclusive remedy still protects her. Which option is correct under UTOR law? A. Exclusive remedy applies regardless of elective status. B. Elective employers lose exclusive remedy. Employee can sue directly. C. Exclusive remedy doesn't apply to negligent hiring claims outside workers' comp scope. D. UTOR law prohibits elective status for businesses over 5 employees. Answer C. Explanation. Under UTOR workers' comp rules, the exclusive remedy generally bars tort suits for job-related injuries. However, negligence outside typical workplace injury, such as negligent hiring or supervision, can fall outside exclusive remedy and allow a suit. Elective status doesn't change core concept, but exclusive remedy is an absolute. Option oversimplifies. If B is wrong and D is unrelated rule. Question 7. Given the circumstances, Leo Martinez owns a commercial condominium in UTOR and carries an ISO commercial property policy covering the unit. After a storm, the association demands ordinance or law coverage to rebuild to current code, which his policy omits. What should he do? A. Ignore. It's the association's problem. B. Accept actual cash value settlement only. C. Add an ordinance or law endorsement to cover increased costs of compliance. D. Switch to broad form to automatically include ordinance law coverage. Answer C. Explanation. Ordinance or law coverage is available via endorsement and protects insured when law requires rebuilding to newer building code, covering demolition or increased cost of construction without adding it. Property limit applies to SFIV RC of damaged part only. Broad form doesn't automatically include ordinance coverage. Must be added. Option avoids legal exposure. Option B limits recovery. Option D misleads. Question 8. Taking into account Isabella Nguyen's underwriting a shipment of expensive electronics for a trade show, she wonders whether inland marine coverage under a commercial inland marine form would cover theft in transit compared to a standard property policy. What is correct? A. Standard commercial property covers theft during transit if within business premises. B. Inland marine policies do not cover theft. They cover only transit damage. C. Inland marine provides coverage for property in transit or at temporary locations, ignoring premises definition. D. Inland marine only applies to ocean shipments, not road transport. Answer C. Explanation. Inland marine insurance is designed to cover movable property, valuable articles or shipments in transit or at temporary sites, including theft or damage, without the geographic limitations of commercial property policy. Standard property form covers losses only at insured premises. Option B misstates. Option D confuses ocean marine with inland. Question 9. With respect to UTOR commercial insured in the context of unfair trade practices, which of the following actions by A producer could constitute a rebating violation: A. Providing full policy disclosures and approved rate schedules. B. Offering insureds a portion of the agent's commission or premium refund to incentivize purchase. C. Explaining differences between policy options. D. Recommending competitors' policy because of better suitability. Answer. B. Explanation. Utah's unfair trade practices statutes prohibit rebating, giving premium rebates, commission, or any valuable consideration not included in policy to induce purchase. Option B clearly is unlawful. Options and C involve disclosure allowed. Option D is permissible advice aimed at suitability, not inducement via value transfer. Question 10. Under the assumption that Utah's commercial auto insurance mandates minimum liability limits, Elijah Wright operates delivery fleet and must comply with state limits. Utah requires minimum bodily injury per person per accident and property damage limits for commercial vehicles. If he obtains $25,000 each person, $50,000 each accident by, and $20,000 property damage liability, has he met minimum requirements? A. Yes. These are the federally required values. B. No. Utah's minimum is $50,000 per person, $100,000 per accident by, with $25,000 PD. C. Yes. State allows $25,000, $50,000 by, and $20,000 PD. D. No. Utah mandates $100,000, $300,000 by, and $50,000 PD for Answer. B. Explanation. Utah requires minimum commercial auto liability, $50,000 per person, $100,000 each accident bodily injury, and $25,000 PD limit. Elijah's limits fall short on all counts. Option C is imprecise. Option cites federal numbers, not applicable. Option D exaggerates. Question 11. Given the circumstances, Rachel Morgan owns a manufacturing business in Utah and purchases a business owner's policy, BOP. After fire, she files a claim for business interruption losses, including lost income and extra expenses incurred relocating production. The insurer denies coverage for lost income because the policy was silent on civil authority closure due to a nearby fire. What is the correct interpretation under typical BOP policies regarding business interruption? A. Business interruption coverage automatically includes civil authority closure losses without explicit wording. B. Civil authority coverage must be specifically included by endorsement or policy language to be covered. C. BOP policies exclude all extra expenses related to relocation after a fire. D. Business interruption losses are never covered if the insured's own property is not damaged. Answer. B. Explanation. Standard BOP forms cover business interruption losses tied directly to physical damage to insured property, losses from civil authority orders, e.g. government-mandated closure, require explicit civil authority coverage endorsements or clauses. The insurer's denial aligns with policy terms if the endorsement is absent. Option is incorrect because coverage is not automatic. Option C misstates extra expense coverage which may be included. Option D is too broad. Losses from civil authority are sometimes covered if properly endorsed. Question 12. From a practical standpoint, Jacob Kim runs a company that ships high-value equipment nationally. He is considering the purchase of difference in conditions, DIC insurance, to fill gaps in his standard commercial property policy, which excludes flood and earthquake. What is the most accurate statement about DIC policies? A. DIC insurance duplicates the exact coverages found in the commercial property policy. B. DIC policies provide coverage only for perils that are excluded or limited in the primary policy. C. DIC insurance is designed primarily for liability exposures rather than property risks. D. DIC coverage is only valid when purchased as part of a package policy. Answer. B. Explanation. DIC insurance is a gap filler that provides protection for risks excluded or limited by a primary policy such as flood, earthquake, or other catastrophic perils. It doesn't duplicate existing coverages but complements them. Option is false because of this complementary purpose. Option C misclassifies DIC as liability rather than property insurance. Option D is incorrect. A DIC can be standalone or part of package. Question 13. Taking into account Amanda Jackson is A claims adjuster reviewing a subrogation waiver clause in a construction contract where her commercial insured waived the insurer's right to subrogate against the contractor after fire caused by contractor negligence. What impact does this waiver have on the insurer's rights under UTHR insurance law? A. The insurer can still pursue subrogation regardless of contractual waivers. B. The insurer is legally barred from subrogation due to the waiver signed by the insured. C. Subrogation rights are transferred to the contractor under the waiver. D. Waiver clauses only apply to bodily injury claims, not property damage. Answer. Answer B. Explanation. Waivers of subrogation, common in construction contracts, preclude insurers from pursuing recovery against the waived party. In UTOR, courts generally enforce valid waivers if clearly expressed. This limits insurers' rights to subrogate, shifting loss costs to the insurer unless otherwise agreed. Option disregards contractual waiver. Option C misinterprets assignment of rights. Option D is incorrect. Waivers apply to property and bodily injury claims if specified. Question 14. When faced with, Michael Johnson operates a fleet of delivery trucks. One driver operating a covered auto hits a pedestrian. The injured party sues Michael's company. Michael is concerned about supplementary payments under the commercial auto policy. Which of the following is an accurate description of supplementary payments? A. Supplementary payments include defense costs, bond premiums, and reasonable expenses and do not reduce policy limits. B. Supplementary payments are part of the policy limits and reduce the available coverage. C. These payments only cover medical expenses to the injured party. D. Supplementary payments cover the insured's lost income while attending trial. Answer A. Explanation. Under ISO commercial auto liability forms, supplementary payments cover costs such as defense attorney fees, bail bonds, appeal bonds, and reasonable expenses incurred by the insured. These payments are in addition to policy limits and don't reduce them. Option B incorrectly treats them as within limits. Option C misrepresents medical payments, separate coverage. Option D is false. Lost income isn't covered. Question 15. From the perspective of underwriting, Emily Reed is evaluating the risk characteristics of a potential commercial insured. Which of the following best explains the importance of the law of large numbers in underwriting and risk management? A. It guarantees every insured will have an equal chance of loss. B. It allows insurers to predict losses more accurately by pooling many independent risks. C. It discourages insurers from spreading risk across multiple policies. D. It applies only to life insurance, not commercial lines. Answer B. Explanation. The law of large numbers states that as the number of exposure units increases, actual losses more closely approximate expected losses, enabling insurers to predict losses with greater accuracy. This principle underlies risk pooling and pricing. Option: a misstates equal chance. Option C is wrong, as spreading risk is encouraged. Option D is false, it applies broadly. Question 16. As illustrated by Kevin Smith is an agent who unintentionally misrepresents the terms of a commercial liability policy to a client. The client later suffers a loss that would have been covered had accurate information been provided. Which legal doctrine could prevent the insurer from denying coverage due to this misrepresentation? A. Waiver and estoppel. B. Subrogation. C. Pro rata liability. D. Assignment. Answer A. Explanation. Waiver occurs when an insurer intentionally relinquishes a known right, and estoppel prevents the insurer from denying coverage when the insured relied on the agent's misrepresentation. These doctrines protect insureds from unfair denial. Subrogation, pro rata, and assignment relate to other insurance principles unrelated here. Question 17. The contemporary view of cyber liability insurance is growing rapidly due to increased data breaches. Olivia Bennett's firm suffered cyber attack compromising customer data. Her commercial crime policy excludes cyber incidents. What type of coverage should Olivia consider to address this exposure? A. Employment practices liability insurance. B. Directors and officers DO liability insurance. C. Cyber liability insurance with data breach and network security coverage. D. Professional liability insurance. Answer C. Explanation. Cyber liability insurance specifically addresses risks from cyber attacks data breaches and network security failures, providing coverage for notification costs, legal defense, regulatory fines, and business interruption. EPLI and DO cover employment and managerial liability, respectively, while professional liability addresses professional negligence, not cyber risks. Question 18. In the context of youth insurance law, Olivia Martinez is studying the role of the Commissioner of Insurance. Which of the following powers best describes the Commissioner's authority? A. The Commissioner can establish policy wording and rates for all insurance companies without consultation. B. The Commissioner regulates licensing, enforces insurance laws, and reviews policy forms and rates for compliance. C. The Commissioner can directly negotiate claims settlements on behalf of insurers. D. The Commissioner has no authority over producer conduct or unfair trade practices. Answer. B. Explanation. UTOR's Commissioner of Insurance oversees licensing of insurers and producers, enforces laws, approves policy forms and rates, and investigates complaints and unfair trade practices. The Commissioner does not draft policy wording unilaterally nor negotiate claims. C. And certainly regulates producer conduct. D is false. Question 19. The fundamental question is Aaron Wells, a commercial insured, wants to transfer ownership of his insurance policy to a business partner. Under typical commercial insurance contracts, what principle governs this transfer and what must Aaron insure? A. Assignment of policy is always permitted without insurer consent. B. Assignment requires insurer's prior written consent to be valid and enforceable. C. Assignment voids the contract immediately upon transfer. D. Assignment is irrelevant. The policies are always owned by the insured's business entity only. Answer. B. Explanation. Most commercial insurance policies contain an assignment clause requiring insurers' prior written consent before ownership or interest in the policy can be transferred. This protects the insurer from unknown parties. Option is wrong. Option C exaggerates. Option D ignores the principle of contract rights transfer. Question 20. When analyzing a commercial insured's risk, Monica Davis notes that her client operates an auto repair shop and employs several mechanics. She wonders about employers' liability coverage in the context of workers' compensation policies. What best describes employers' liability coverage? A. It covers statutory workers' compensation benefits only. B. It protects the employer against lawsuits for work-related injuries not covered by workers' compensation statutes. C. It is mandatory in youth or for all employers regardless of size. D. It replaces the need for workers' compensation insurance. Answer. B. Explanation. Employers' liability insurance is a component of workers' compensation policies covering the employer's legal liability for injuries or illnesses not covered by workers' comp statutes, such as third-party lawsuits alleging negligence. Option describes workers' comp itself. Option C is inaccurate. Some youth employers are elective. Option D is false. It supplements, not replaces. Question 21. In the modern context of insurance claims, Daniel Foster owns a commercial building insured under special all-risk policy. After a burglary, several expensive items are stolen, but the insurer denies the claim, citing a vacancy clause because the building was unoccupied for more than 60 days. Daniel contests this decision. How should this vacancy clause be interpreted under youth or commercial property insurance principles? A. Vacancy clauses only apply if the building is completely empty of all contents. B. The vacancy clause can reduce or void coverage if the building has been vacant beyond the specified time, regardless of contents. C. Vacancy clauses are unenforceable in youth or due to consumer protection laws. D. Vacancy clauses do not apply to theft losses, only to fire losses. Answer. B. Explanation. Vacancy clauses in commercial property policies generally restrict coverage if a building remains unoccupied or unused for a defined period, often 3060 days, increasing risk. Youth courts uphold these clauses, permitting insurers to limit or deny coverage if vacancy conditions are breached, regardless of some contents being present. Option is incorrect because partial contents do not negate vacancy. Option C is false. Vacancy clauses are valid contractual terms. Option D is wrong. Vacancy clauses apply to multiple perils, including theft. Question 22. While evaluating risk management strategies, Sophia Grant's business operates heavy equipment which she plans to insure under equipment breakdown insurance. She asks how this coverage differs from standard property insurance and what types of losses it protects against. What is the most accurate explanation? A. Equipment breakdown insurance only covers losses from natural disasters. B. This insurance specifically covers sudden and accidental mechanical or electrical breakdown of covered equipment, unlike standard property policies. C. Standard property insurance includes all equipment breakdown losses automatically. D. Equipment breakdown insurance applies only to personal property, not commercial equipment. Answer B. Explanation. Equipment breakdown insurance, also known as boiler and machinery insurance, fills gaps left by standard property policies, which typically exclude losses caused by mechanical or electrical breakdown. It covers sudden and accidental breakdowns of machinery and equipment, such as boilers, HVAC, or manufacturing equipment. Option is false, and natural disasters are covered by other policies. Option C is incorrect, as standard policies exclude this risk. Option D misclassifies the insured property. Question 23. Given the circumstances David Lee is reviewing, a commercial general liability (CGL) policy for his contracting business, he wants to understand the difference between occurrence and claims-made policies and how they impact coverage for past acts. Which statement best reflects the difference in coverage triggers? A. Occurrence policies cover claims only if reported during the policy period. B. Claims-made policies cover claims arising from incidents that occur in a time as long as they are reported during the policy period. C. Occurrence policies cover incidents that happen during the policy period regardless of when claims are reported. D. Claims-made policies cover claims regardless of when the incident occurred. Answer C. Explanation. Occurrence policies trigger coverage when the insured event occurs during the policy period, even if the claim is made later. Claims-made policies require both the incident and claim to occur during the policy period or extended reporting period. Option A reverses occurrence policy principles. Option B inaccurately states claims-made coverage applies regardless of incident timing. Option D is incorrect. The claims-made policies depend on claim timing. Question 24. In light of recent developments, Anna Richards' Utah-based consulting firm is exploring professional liability insurance. She wonders whether a standard commercial general liability (CGL) policy would cover claims of negligent advice resulting in client financial loss. Which is the most accurate answer? A. CGL policies cover professional negligence claims by default. B. Professional liability insurance is necessary as CGL policies exclude errors and omissions. C. CGL policies cover all types of liability, including professional malpractice. D. Professional liability insurance only covers bodily injury claims. Answer B. Explanation. CGL policies generally exclude coverage for professional errors, omissions, or malpractice, requiring a separate professional liability errors and omissions policy to cover negligence in professional services. Option A is false, as CGL explicitly excludes these claims. Option C incorrectly broadens CGL scope. Option D misclassifies professional liability coverage. Question 25. From the perspective of Utah insurance regulations, Jason Miller is studying the rules regarding policy cancellation and non-renewal. His commercial property insurer wants to non-renew his policy but has not given 30 days written notice. Which statement best reflects Utah's legal requirements? A. Insurers must provide at least 30 days written notice before cancellation or non-renewal. B. No notice is required for non-renewal of commercial policies in Utah. C. Only 10 days notice is required for cancellation due to non-payment. D. Notice requirements do not apply to commercial insurance. Answer A. Explanation. Utah law requires insurers to give a minimum 30 days written notice for cancellation or non-renewal of commercial policies, except for non-payment where shorter notice, usually 10 days, may apply. This protects insured's right to seek replacement coverage. Option B and D incorrectly state no notice is required. Option C is partially correct for cancellation due to non-payment but not for non-renewal. Question 26. As demonstrated by a recent claim, Michael Alvarez's company suffered fire loss but discovered some property was insured under two different policies covering the same risk. How should the pro rata liability principle apply in settling the claim? A. The insurer that issued the first policy pays the entire loss. B. Each insurer pays proportionate share of the loss based on their policy limits relative to total coverage. C. The insured can collect full claim amounts from all insurers without limitation. D. Only one insurer is liable and others are released from obligations. Answer. Answer. B. Explanation. Pro rata liability in insurance requires multiple insurers covering the same risk to share the loss proportionally based on their coverage limits. This prevents the insured from collecting more than the total loss and fairly distributes liability among insurers. Option is incorrect as no. First insurer pays all. Option C leads to over-indemnification, which is prohibited. Option D is wrong. Question 27. Throughout the course of a claims investigation, Melissa Carter's insurer discovers evidence suggesting insurance fraud related to commercial auto claim. What is the appropriate response under UTA insurance regulations? A. Immediately deny the claim without investigation. B. Conduct thorough investigation and report suspected fraud to UTA's fraud unit if warranted. C. Pay the claim to avoid legal liability and sue later. D. Ignore the suspicion unless the insured admits to fraud. Answer. Answer. B. Explanation. UTA insurance law requires insurers to investigate suspected fraud thoroughly and report it to the fraud unit or appropriate authorities. Denying claims without proper investigation may, or ignoring suspicions, D. Violates regulatory standards. Paying the claim prematurely, C. is inadvisable and may undermine fraud detection. Question 20. In terms of commercial crime insurance, Olivia Harris wants to protect her business against employee dishonesty and forgery. Which type of coverage would best address these risks? A. Employment practices liability insurance. B. Commercial crime insurance including employee dishonesty and forgery coverage. C. Directors and officers liability insurance. D. Professional liability insurance. Answer. Answer. B. Explanation. Commercial crime insurance typically includes coverage for employee dishonesty, theft by employees, forgery, and other fraudulent acts against the insured business. Oblidio and professional liability cover different exposures unrelated to crime or theft. Question 29. By evaluating, Sarah Thompson's firm is assessing the risk of adverse selection in its commercial insurance program. Which of the following best describes adverse selection? A. Insurers selecting only the best risks to insure. B. High-risk individuals or businesses being more likely to purchase insurance or seek higher coverage. C. Insurers randomly selecting clients without underwriting. D. The process of assigning risk classes based on experience rating. Answer. Answer. B. Explanation. Adverse selection occurs when high-risk applicants are more likely to purchase insurance or increase coverage, potentially leading to higher loss costs for insurers. Proper underwriting and pricing mitigate adverse selection. Option. It describes risk selection by insurers, not adverse selection. Options C and D are unrelated. Question 30. The underlying principle of a builder's risk policy is essential for contractors. John Wilson is about to start construction of a new commercial warehouse and wonders what type of coverage this policy provides. Which of the following is true? A. Builder's risk policies cover completed structures only. B. Builder's risk covers buildings under construction, materials, and supplies on site or in transit until project completion. C. Builder's risk policies provide liability coverage for construction defects. D. Builder's risk policies exclude fire and theft risks during construction. Answer. Answer. B. Explanation. Builder's risk insurance covers the building under construction, including materials and supplies on site or in transit, protecting against losses such as fire, theft, or vandalism until the project is complete and accepted. Option A misstates timing. Option C confuses property with liability coverage. Option D incorrectly excludes fire and theft, which are standard covered perils.